Good morning, and thank you all for joining us. My name is Brenda Carter, and I'm the state representative from Michigan, which is better than South Carolina. Anyway, he's going to love that. Anyway, I also serve as chair of NCOIL's Life Insurance and Financial Planning Committee, and I will be moderating this general session on trends and innovations in long-term care insurance coverage and financing. As the U.S. population ages and care needs grow more complex, please silence your phones. Long-term care insurance is undergoing a quiet but significant transformation. Once viewed as a niche product with limited uptake, it's now at the center of a broader conversation about how we finance aging with dignity, independence, and choice. Today's discussion will explore the evolving landscape of long-term care insurance, and we'll hear about different approaches from states and insurers have taken to help improve the overall marketplace. We ask you to hold all questions until the end of all presentations. Okay. I'm missing something here. Here we are. Joining us today to discuss these issues are Jan Graver, Senior Actuary at the American Council of Life Insurers, Ben Vegti, Director of the Washington Care Fund, Steve Kane, Director of LTCI Partners and Chair of Finesca's LTC Working Group, and Steve Schoonveld of CGC Consultants and a member of the NAFTA Massachusetts and the NAFTA LTC Legislative Working Group. We'll first hear from Ben. Please go ahead. Ben?
Yes. I'm sorry, I was just talking to him. Good morning. Good morning. Thank you.
Good morning, Ben.
All right. My name is Ben Vegti. I'm director of the WA Cares Fund, which is the first public long-term care insurance program. Good morning. My name is Ben Vegti. I'm director of the WA Cares Fund, which is the first public universal long-term care insurance program in the country. And I'm here to talk to you about our program as well as recent innovations. I mean, the program itself is a tremendous innovation, and on top of that, we are now expanding the program to look at public-private partnerships. So I'll talk about that today, and you'll hear more from the other panelists on some on this innovation and some on other innovations. Could you go ahead and play the video, please? So there's a couple of takeaways from the story of Sunny and Yunhee, these two nurses in Seattle. One is that it's the care burden that we have as a society is not equally distributed across all of us. We all have adult family members who need to be cared for, but right now the burden is almost exclusively borne by women middle-aged women who sacrifice their careers to care for not only their own parents, but often their spouse's parents. And that is something that has gone under the radar in recent decades. We have a history of sexism and racism in this issue of care, right? I mean, going back to slavery and going back to domestic servitude. And even today, in many states, care workers are dramatically underpaid, have low benefits, and sometimes if live-in caregivers, it can be a quasi-slavery situation in some states. So it's a huge problem. So one of the takeaways is that this burden is borne disproportionately by women. Another takeaway is that it hurts the economy because women, you can see Sunny and Yen here, very productive stage of their careers. They could be contributing to the economy and helping the state's economy grow, but instead they had to step back. And the third takeaway that I have from this story is that it's not just a problem that low-income people face. It's a middle class and upper middle class problem as well. We have a sort of mythology in our country that if everyone works hard and plays by the rules, they can earn enough money to pay all their bills. And so people feel like they're failing when they can't do that. But the reality is that even if people work hard and play by the rules, they're not able to pay for long-term care in many cases. And so it's not just a program, it's not just a Medicaid issue, it's an issue for the broader middle class, which is why in our state we enacted a universal program. So long-term care is a predictable and expensive risk. 7 in 10 of us are going to need long-term care. It's like assistance with things like eating, bathing, dressing, and getting around. It's not covered by health insurance or Medicare. It's expensive, and Medicaid is not a solution for almost anyone because Medicaid is a safety net if you fall, but nobody's plan for retirement is that I'm going to not save for retirement so that when I'm 85, I have less than $2,000 in life savings. Like that wouldn't be, we don't want people to plan for retirement that way. We want people to save for retirement. So right now, if you want Medicaid, the only solution we have is a solution that disincentivizes retirement savings, which is, just counterproductive in many ways. This is going to become a bigger problem in the coming years because if you look at the red line in this graph, the population 85 and older is quadrupling between 2025 and 2050 in our state, and it's similar in other states across the country. So you're going to have 4 times as many people needing long-term care in 2050 as do today. Clearly, families won't be able to cope with this. More and more people are going to have to leave the workforce to care for older adults. It's going to hurt the economy, and it's going to hurt the retirement security of those individuals. And a lot of older adults will just suffer in silence. You see in Japan, which has even a worse demographic pyramid than we do, you have a lot of suicide by older adults who live alone in their apartments. And it's a phenomenon that has become widespread in Japan. And if people are alone and can't afford for anyone to come and take care of them, it can be a miserable way to spend the last few years of your life. Because of the age dynamics with more older adults, we also have fewer the generations behind the boomers and the Gen X are thinner. So as a result, there'll be going to be fewer family caregivers for older adults. In 2010, there were 7 people of prime caregiving age, 45 to 64, for every person 80 or older. By 2050, there will only be 3 people of prime caregiving age for every person 50 or older, which means we'll have a shortage of care workers and a shortage of family caregivers. So this really is a tsunami that's coming at us. It's not the age wave that's the tsunami, it's the fact that it's all of these factors together that there aren't enough there won't be enough family caregivers, it's expensive, people won't be able to pay for it out of pocket. It's a financing problem is immense, which is why we enacted WA Cares. Most families approaching retirement don't have a way to pay for long-term care. In our state, among seniors, median household income is $56,000 a year. After taxes, that's clearly not enough. It's barely enough to live, much less pay for health care and long-term care out-of-pocket costs. Among workers approaching retirement in our state, 41% have no pension and no retirement savings. Another 42%, so now we're up to 83% total, have no pension and only enough retirement savings to replace less than 10% of their pre-retirement income. So maybe $600 a month. Plus Social Security, and then if they're able to work, right? So, and of course, people can't work deep into their retirement, and if they do have any retirement savings, they tend to exhaust it by the time they're in their 80s. And so this is a major problem affecting families in our state and affecting families across the country. In the last biennium, we have biennial budgets. We spent 9% of our budget on long-term care, not Medicaid, but just Medicaid long-term care. In the current biennium, it's going to be a higher percentage, and this problem is going to get worse and worse. We're already having to cut. We had to cut the agency that administers Medicaid, which is my agency, by about 10 or 15% this year, our budget, because we have rising caseloads and we have to balance our budgets. We cut staff this time, but if every year as caseloads increase, we have to cut further, it's going to really threaten. I really think that Medicaid in 20 years won't be what it is today. It won't cover long-term care nearly as much as it does today. We're going to have to make it harder to qualify. We're going to have to lower benefits, restrict benefits in various ways to control costs. And it's just not, Medicaid is not the solution to this problem over the long term. It's an important part of the solution, but alone it certainly can't solve the problem that all of our families face. So in our state, we researched a variety of solutions between 2014 and 2019. Ultimately, after actuarial analysis and expert testimony, we landed on this design, which is similar to Medicare hospital insurance. Everyone pays in out of every paycheck, and then when they need care, they have access to $36,500 of benefits. The program had some problems initially, but we've ironed those out now. The two biggest problems were, one, that you had to pay in 10 years to qualify, so people close to retirement couldn't qualify. We fixed that now that if you're born before 1968, you earn 10% of the full benefit for every year you contribute. So it's a prorated benefit for that cohort. Solves that problem. And the second problem was that benefits weren't portable, but we fixed that in 2024. So our legislature made benefits portable so that now anywhere you go, if you leave the state, you can get your benefits anywhere else in the country, and we're trying to even make it available internationally. And then this year we enacted, we realized that the last remaining weakness of our program is that it's a modest benefit. Now that's ineluctable, because if you have a modest premium, which we do, we have a 0.5% of wages is the premium, then that has to finance the benefit. The money that we collect has to finance the benefit because we don't receive any general fund subsidies. So the benefit is $36,500, so we decided to work with private insurers to develop a supplemental private market. And we enacted the statutory framework for that this year. So by 2027, we expect a market to emerge where carriers can offer coverage that takes the Walk Cares benefit as the deductible and supplements it with another $50,000, $100,000, $150,000, $200,000 of coverage. So someone like myself, who's upper middle class, my wife and I plan to buy another $150,000 of coverage on the private market. It should be cheaper than those policies are today because it's taking Walk Cares as the deductible. So the carriers should be able to price these more affordably and hopefully become accessible to middle-class consumers. So initially, original state was here on the left, where we had the mandatory program, which is Walk Cares, and then we had exemptions. People who wanted to opt out of the program could buy private insurance in order to exempt themselves from the public program. That was a counterproductive dynamic because that sort of cannibalized our risk pool, where carriers would, just because of the nature of the free market, they would cherry pick, and the healthiest high earners would opt out. The sicker or lower earners would stay in, and the danger there is you create a high risk pool instead of a universal program. If Medicare had exemptions, Medicare would be even in worse financial shape than it is currently, right? So we fixed that in 2020 and 2021, and now anybody who had bought insurance prior to that keeps their exemption, but there's no exemptions going forward. And so that's the middle column here. Over time, the program will become completely universal because those workers will age out of the workforce. And then in the future state, we see on the right here, with the new statutory framework for supplemental private insurance, Walk Cares is the foundation, kind of like Social Security is in the retirement space. In the retirement space, if people want more security, they save through the 401k and the IRA system. Now in Washington State, we have mandatory public insurance, which everyone has access to. So everyone has a foundation of dignity and security in retirement. If people can afford and want to buy more insurance, they'll be able to buy it on the private market. This way, it's a great public-private partnership because it doesn't undermine our finances, because it's not done through exemptions and cherry picking, but rather through us as the foundation and then the private market as the supplement. And we plan on working with private insurers to communicate this to the public, to market it to the public, so that they understand that this is a constructive relationship and that they can trust the private insurance products that are offered. The framework that we enacted has good consumer protections. So there's a trust problem in this sector, and we hope that through this public-private partnership, we can really increase the number of middle-class consumers that can afford private supplemental insurance and that end up buying those. So I think it's a win-win for the carriers, for the brokers, for the state, and for the families in our state. I'll stop there.
Thank you, Ben. Now we'll hear from Steve Kane. Steve, the floor is yours.
Thank you. My name is Steve Kane, and I lead a national insurance brokerage called LTCI Partners, and we focus on individual and group long-term care solutions. I also chair the long-term care working group for FinSECA, which is an industry trade association. And so I just want to take a few minutes and give you kind of an advisor's perspective or an agent's perspective, in addition to a consumer's perspective, because that's who we're working with on a daily basis. I live in Los Angeles. I've got married 2 teenage daughters that just run me, but so does my 84-year-old mom. And this issue is deeply personal to me. We're going through a long-term care event with my mom right now. It's stabilized, we're happy to report, but it is expensive. Just to add to what my friend Ben was talking about, she's in an assisted living facility in suburbs of Los Angeles where we live, and it is $14,000 a month.
How much?
And she's been in there for a year, and she's thriving. I mean, right now she's probably playing cards, right, taking people's money. But she's thriving, and when my brothers and I'm in the middle, talk about it, we talk about how are we going to finance this for a couple more years. Now, we are fortunate that we do well, but not as many people are fortunate. I remember walking out of that assisted living facility with my older brother who was signing the contracts, and he looked at me and said, "Steve, how do people do this?" And I said, "Rob, they don't, right? Mom comes in and they move in with the family. People leave jobs. It is a significant societal challenge that we have to figure out." And ready for my disclaimer, as an insurance agent and advisor, I think public programs are okay. Yeah, I just want to work with Ben and other states as opposed to work against or beat up one to sell the other. And I think that's why I'm here today. I think that's the future of these programs, is public and private partnership. And the other disclaimer is, as an insurance industry, we haven't cracked the nut. Like, we've done really well distributing long-term care and life insurance solutions to affluent people, but there are more people that are not affluent that we need to help. And I think we could do it with the current set of products that are out there. We need to innovate. We need to make them more affordable. But it's a challenge. And I think the challenge starts with the folks that we're meeting with. If I ask people, do they want to talk about long-term care, I think they'd rather go to the dentist, or the CPA. Every time I'm on a golf course and somebody asks me what I do, that ends conversations, right? But these are hard conversations. Like, let's be honest about it. Nobody wants to talk about being vulnerable, being frail, needing assistance or support during your aging years. And we know with medical advances, the way we eat and exercise, we're going to live longer, but with chronic ailments. We know there's caregiver shortages. We know this stuff is going to get more expensive in terms of the care. It's a supply and demand issue. It's basic economics. We also know that there's incredible strain on Medicare and Medicaid today. And so we want to partner with states to find the right solutions. We do think the private market provides tremendous value. But again, going back to the consumer, these are hard conversations. I think it's a denial issue for a lot of people. Stick your head in the sand. I don't want to think about it. I think it's an affordability issue for a lot of people. This is not a statutory product. In California, where I live, you have to have auto insurance. You have to have homeowners insurance. You don't have to have long-term care insurance. So it's a discretionary spend in what we all perceive to be a very fragile economy. And so as all my other insurance costs are going up, I mean, gosh, my homeowner's insurance in California was impossible to renew. And every part of insurance, without even claims, are going up. And so do I have extra dollars to pay for long-term care? So I think a lot of families are challenged with that as well. So, we as an insurance industry, in terms of the distribution side, we've got to continue to bang the drum. We've got to continue to have the hard talks. But I got to tell you, there's been challenges. That we have a PR issue in our business. You have a first generation or iteration of products that didn't work that well. given the fact that the insurance companies didn't have tremendous actuarial experience. So they made mistakes in terms of their pricing, and consumers paid for it or are currently paying for it in terms of rate increases. So what does that do beyond upsetting consumers? It upsets the advisors who place that coverage. So what we saw was advisor apathy to this issue, where if a financial advisor that writes 2, 3, 4 policies a year is faced with rate increases, that leaves a bad taste in his or her mouth. And they're saying, look, I don't even want to bring this up because it can jeopardize my relationship with this client. And so they choose to avoid it, which isn't helping anybody. People just don't plan. So I think we're slowly but surely getting over that. These products today are priced appropriately. The carriers have now 30 plus years of experience. We think the market has stabilized. I say that because I sit on advisory boards helping insurance companies develop products. And there are a number of companies that I'm under an NDA with right now that are entering the market. They look at the demographics that Ben shared, and they say, we want to be here. We want to play here. We just need to do it profitably. We need to figure out a way to do it profitably and provide affordable coverage to people. Also, just in general, what I've learned is that bad news travels faster than good. So you're going to read a story about a terrible claims event, or a poor woman that was declined for a claim. What you're not going to read about is the fact that the insurance industry paid out $16 billion with a B in claims for long-term care last year. And those are expected to, really grow over the next 10, 15 years. So this stuff works. I've seen it firsthand with clients of ours, with the business that we're in. I'm not sure you get over the fact that people don't want to talk about insurance. Only a small percentage of our population are really planners, but we've got to continue to, talk to people about it. We need to innovate, and we need help in that innovation from state departments of insurance and from legislators to enable the insurance companies to come out with products faster, and then creative products, maybe that don't fit the mold of the old products that we're distributing today. We have seen a shift in the industry towards combination life and long-term care policies. The insurance companies have a better handle on pricing life insurance than they do long-term care. Those are very popular amongst not only the carriers, but amongst people, us, right? It's a dual-purpose policy. I know win, lose, or draw that I'm going to get something from this policy. But there are still traditional long-term care or standalone carriers out there that feel like they have a handle on the pricing and their products are affordable today. What Ben and the Washington Cares Fund did for the industry was kind of legitimize long-term care as an employee benefit, where many employers were running to offer, we saw an unprecedented surge in interest in long-term care because of the Washington Cares Fund. Now, we kept it right down the middle. We said, hey, it's a good program, but you might want to augment what Ben was sharing about the supplemental coverage, and we did it at the time in 2021. But what it did was companies from around the country, from states that you're in, said, hey, we might do this. If Washington's doing it, the numbers might make sense for our state, so let's offer this as an employee benefit. So right now, today, voluntary worksite life plus long-term care insurance is the #1 fastest growing voluntary benefit in the industry. It has broad appeal across different types of businesses. It's lowered the purchase age, which is good for the industry. Average purchase age is around 47 years old, and it is much more affordable. You're not buying the most benefit-rich contracts in the world. You're doing something, and that's frankly what a lot of people need to do is hedge against this big risk and do something. Because I'll tell you, if somebody came to me, and by the way, I'm a bad agent. I didn't sell my mom long-term care insurance years ago. But if somebody came to my brothers and I and said, hey, guess what? We're going to give you guys $3,000 a month to take a dent out of that 14, we'd be thrilled. And so that's what folks are doing in the work site. But we do have some challenges in terms of product availability. If you ask me, what's the biggest challenge that you face today? It's not getting people to nod their heads saying long-term care is a terrible idea. I don't get kicked out of any meetings, right? Everybody's got a personal experience with long-term care. It comes down to the delivery of the solution. Sometimes I'm handcuffed as to what I can offer where, or sometimes I have to offer one product to a certain subset of a population and another product to others, and that makes it a challenge. So we hope to not only work with folks like Ben on the state public-private side, but also with legislators and with state departments of insurance to ensure that we have innovation in terms of product and accessibility in terms of the product as well. I'll turn it over to the next speaker.
Well, I'd like to make a comment on what you said real quickly. I really appreciate you bringing it to our attention about the population that are underinsured or uninsured that may not have access or ability to have long-term care. In Michigan, we have 40% of our population below the threshold where it's called the Alice population, where they can't afford insurance and their food at the same time. So I really appreciate somebody from the industry highlighting that opportunity.
Thank you.
Jan?
Do you have the clicker? So, good morning. I'm Jan Graber. I'm Senior Actuary at the ACLI, and thanks for having me. And so, you've already heard a little bit about some of the, new ideas and innovations that are taking place in the long-term care space in response to this issue that really catches people off guard. And I think, before we get into more of that, I thought it would be helpful just to level set on a few key statistics, and I think you probably already have heard these. We've heard some of these from the prior speakers, but I think it's worth repeating again. And then I want to focus on one of the most important things that our members believe needs to happen, and that's helping people understand both the potential need for care and then the cost of that care. So just some statistics, every single day, 10,000 Americans will turn 65, and nearly 70% of them will need some type of long-term care at some point in their lives. And this isn't a temporary trend. The senior population is growing fast, from 58 million in 2022 to about 82 million by 2050. That's a 47% increase. And then the cost associated with long-term care, as you've heard, is rising as well. So right now, hiring a home health aide costs about $77,000 a year, and even adult daycare, which is really the least expensive care option, that averages about $26,000. If higher care is needed, assisted living is running on average around $77,000, but as you heard from Steve, it can be much higher than that. And then a private room in a nursing home runs almost $130,000 a year. And the average cost, or the average long-term care event, is about 3 years. So you can kind of do the math, and that's a lot of money. That doesn't, it doesn't only strain families' budgets, but it can also drain retirement savings as well and force families to make some tough decisions about care. Most Americans that are planning around long-term care are planning around the wrong assumption. So, 60%, nearly 60% believe that Medicare will cover long-term care when they need it, and we know that it won't. And just as an anecdotal, example, like Steve, I'm dealing with a long-term care event with my mother, and my sister and I recently went to look at, she was at independent living, look at assisted living facilities. We go in, it's, right around $10,000 a month. We walk out, I feel sick to my stomach. My sister's thinking, she has insurance, not long-term care insurance, she has health insurance. And I'm like, Jill, that doesn't cover long-term care. So, as we're kind of deep in the weeds, we know that, but what we're finding is just the average American does not. Another, like 59% are counting on Medicaid, but they don't realize that they have to spend down their assets to qualify, And by the time they realize that hard truth, then it's too late. And most people want to age in place or age at home. 77% say they want to stay in their homes as they age, but the reality is many of them can't. About 40% say that their homes aren't accessible, and nearly half can't afford to make those modifications so that they can stay in their homes safely. Okay, am I pushing? Oh, there we go. So I just wanted to give a quick snapshot of what the long-term care market looks like today. So right now, about 6.5 million Americans have those standalone long-term care policies. And these, like I said, are the traditional standalone policies. They cover coverage for long-term care needs, but this market's changed dramatically. So in the early 80s or late 80s, early 90s, there were more than 100 companies in the market that were selling standalone long-term care. And today that number's dropped to about 6 that still offer traditional long-term care. And as Steve said, the market has shifted to these hybrid policies, or sometimes they're called combination products. And these are life and annuity products that also provide a long-term care benefit. So it allows the policyholder to accelerate, part or all of their death benefit if a long-term care event arises. So these have become really flexible because, it does offer that flexibility. If someone needs the care, the policy is there. If they don't, then there's a death benefit available to their beneficiaries. And this is the fastest growing market segment in this space. But regardless of the type of coverage, the private market plays a very big role. So just last year alone, carriers paid out more than $10 billion in long-term care claims, and that $10 billion directly helps families pay for home care, assisted living, and nursing home care. So the takeaway here is that private long-term care insurance, whether it's hybrid or traditional, continues to help millions of Americans manage what could be one of the most overwhelming costs that they'll face in their lifetime. So looking at why the private long-term care insurance market matters, it doesn't just benefit families, but it also benefits public programs like Medicaid. So every person that buys a private long-term care insurance policy means potentially one less person relying on Medicaid to cover their care costs. And then that allows Medicaid to focus on those who truly lack the resources to fund their care. And this impact is real. Current private long-term care insurance policyholders are expected to save Medicaid about $14 billion over the next 10 years. And that's just from people who already have policies. And then over a lifetime, that adds up to about $48 billion in avoided spending on a present value basis. So by encouraging private market coverage, we're helping families and protecting public programs as well as taxpayer dollars. And I just want to mention, prior to joining ACLI, I spent about 2 decades at the Texas Department of Insurance, and this chart is one that really resonated with both commissioners and legislators that I spoke with, and it really highlights what I call the value proposition of long-term care insurance. So the numbers that are underlying what you see on the screen, the graph, is based on an actual policy of a friend of mine. And so what we're looking at here is a comparison between total premiums that someone would pay for their policy over time and then the potential benefits that they could receive if they go on claim. So as this chart shows, if someone purchased this policy at 50 and then they go on claim at 70, they've paid in about $50,000 in premium, and that's a lot. But compare that to if they need care. So if they need care, and because the cost of care continues, your benefit continues to increase over time, especially, if you purchased inflation protection. So if they actually need care, that person that's put in $50,000 could receive over $1 million in benefits, and that same pattern kind of holds true if you claim at 80 or 90. So what does this tell us? It tells us that long-term care isn't just a monthly bill. It's protection, it's peace of mind, it's a way to help people avoid exhausting their lifetime savings if they face a long-term care event. And finally, as I've worked with our member companies over the past few years, one thing keeps coming up when we talk about how do we build a more sustainable, affordable, long-term care system, and that's education. So at its most basic level, we believe that people need to understand four things. What long-term care actually is, what it really costs, what Medicare or Medicaid pays for and what it doesn't, and why planning early makes such a difference. And without this basic understanding, most people either assume that they're never going to need care or they think the government is going to cover it, which we know is not the case. And by the time they realize that, it's often too late. So education does need to be a part of the solution, but that's not enough on its own. Like Steve was saying, we also need to focus on expanding product options, on innovation, on affordability, and considering bigger picture solutions, whether it's state programs or another type of public-private partnership, or even new models that we haven't yet seen. So with that, I'm going to pass it over to our second Steve.
We have one small comment for
Oh,
everyone
okay.
in the room. These slides are available online, so I see a lot of people taking pictures. You can get this whole entire presentation online. Okay, now our final person will be Steve.
Thanks, and very much appreciate being here today. I remember meeting you a couple of years ago, either in Minnesota. I spoke in Minnesota at this NCOIL meeting. In fact, I remember 13 years ago speaking in Burlington, Vermont on the Class Act, which we're still here talking about long-term care public policy work 13, 14 years later. And we should be ashamed. At least I feel ashamed for that. So I'm here, though, as a NAFA member. And there's this 33-year actuary who's been at this now for 33 years, leaving Illinois 33 years to go to Boston, then now as a advisor. Yes, back in May, I took the exams. I passed them within like 45 minutes, and now hoping to help bring solutions to employers and individuals as well. But I'm not going to leave the public policy actuarial work I really, really enjoy. And so I've spent some time since the Class Act working on such panels, including the Washington Care Supplemental Task Force. About a year or two ago, I did a very, along with a lot of colleagues from other companies, a very involved research report for Minnesota's Department of Human Services, presented that to you at NCOIL in Minnesota as well, at least the status of it, was a highly deep study. So I'm surprised it's 9:40 and we're supposed to go till 10:30. I appreciate that, 90 minutes on long-term care. Let's use all 90 minutes if we can. I won't use the rest of the time, but I'm going to get deep into the public policy considerations here because I'm still an actuary. I'm not going to forget that. And one day I'll be as good as Steve as an advisor, although I haven't sold it to my mom either, so another reason to be ashamed. Okay, so let me get to it then. So emerging trends. This is about emerging trends in long-term care, and Steve did a good job, and so did Jan, about the increased desire in the group and worksite space for those modest hybrid solutions, life with long-term care, small amounts of coverage, but through the employer space, with the joy of underwriting that comes through employee, the lack of underwriting that comes through an employer market. And this, you can get some specific type designs for those employers as well. So it's a great emerging space. Worked on it in the past as a product actuary, but it's a great opportunity for middle income participation in the long-term care space. And that's what this is all about. Public policy, public-private collaboration is about reaching the middle income so they don't fall into the lake, the pool of Medicaid. They can stay upstream into the private sector or into their own personal solutions. So that's one big emerging trend right now. The second one is the state and federal initiatives to which Ben has talked about. We have Walk Cares. We have the WISH Act. Congressman Tom Suozzi of Long Island has re-proposed 4 years later after returning back to Congress the WISH Act, and I've been engaged to work with him on designing what that will look like in the future. So it's been proposed in Congress. It is not a first dollar. It's probably 18-month or 36-month dollar type benefit, but something really to pay attention to because that is beginning to look like true public-private collaboration, which is what I really want to focus on here as well. My own state right now, the Commonwealth of Massachusetts, produced an actuarial study. Apparently that wasn't good enough, which is a good thing for actuaries to hear, by the way. They're putting a commission together to help evaluate that and also bring other alternatives to the forefront. And that's going through both the House and the Senate very, very quickly. I testified last month on Beacon Hill as a 3-day-old NAFA member. NAFA has been working before he even saw a single policy, so it's a good thing. And so we're looking forward to see that commission get together. And a study that recently came out really calls for what it is that people want. And this is from the Employee Benefit Research Institute. And the talking point you normally hear in this study is that it says 64% would pay an additional state payroll tax. It's a very good nationwide survey of about 2,500 employees at a nationwide company which you all probably receive packages from on your doorstep. And it did focus on those states where they have been talking about this public program. But if you go a little further into the research, not only did 64% say they pay an additional state payroll tax, but 57% also said they would pay higher Medicare taxes, or 56% would prefer a public-private program. 55% would pay higher Social Security taxes, and 53% we wouldn't. So basically, when you go through those numbers, they're all saying, give me something to buy and deal with this coverage. It doesn't have to be a payroll tax. It doesn't have to be Social Security tax, but give me something that I can buy as an employee to protect myself in the future. And that should be something we all listen to in this, whether it's your legislator, your Department of Insurance, your Department of Commerce, Human Services, the carriers, the trade organizations. We all need to be thinking about giving something to the middle-income population. A little bit off script here, but we've had this kind of model reg right now for long-term care insurance policies for about 25 years. And how many remember what we used to listen to 25 years ago music-wise? We had these individual CDs, right? Now you get the entire jukebox of the entire world on your phone. Products haven't changed in 25 years, but yet our music is so much more robust and technology-based. We need to do the same thing in the long-term care space. Back then, I bought my long-term care policy. I worked for a vendor, a consulting firm in Boston that provided at least 3 years of benefits. I continued to pay the premium. It cost me $300 a year. $300 a year, and that's after 2 rate increases. So we used to have a very, very robust middle-income long-term care solution, but somewhere, somehow, it went awry or went missing. But I do have a lot of optimism for the group worksite hybrid solutions because they bring that kind of policy back to fore. And I look forward to help producing that in the future. So that's very important. Give me something is what they're saying, and I think that's not just these 2,500 employees, but employees across the country. Another very emerging trend is wellness and care coordination benefits, and this goes into my policy concerns or questions as well. We've been doing a lot of wellness type initiatives in the private insurance market from something I created while I was at Lincoln called concierge care. So it helps families and the claimants provide and navigate through the care malaise. One of the things we found out in the Minnesota study is that the first thing people need is care navigation support. They don't necessarily need the financial means, but even our own stakeholders were telling us, hey, I have no idea how to help my mom. And care navigation, if you have some means or you have the ability to do some caregiving at home or on the weekends kind of thing, is a wonderful thing. And we need to empower families to find the most cost-efficient way to receive care for their loved ones. It doesn't necessarily mean finding the assisted living facility, but that does happen. But it does mean early and often. And right now, the early and often interventions, and right now the long-term care insurance products can't touch anyone until they're 2 6 ADLs or severe cognitive impaired. Have you ever tried to not do 2 of those 6 ADLs and ask your spouse to help you or your family member to help you? You can't do it. It's way too late. And so carriers want to get involved earlier. And so they're spending some of their own money, not the money of the policies, to get involved earlier, to keep people off claim, to help them get the experience they want, and that's not to have to use the long-term care benefit in the first place. So federal programs like the WISH Act, like I mentioned, and additional state-based programs are indeed being considered. That's an emerging trend. Like I said, in my own state of Massachusetts, we are beginning to evaluate that. And remember that all baby boomers, and you guys have talked about this already, will reach 65 by 2030, and soon there'll be roughly 6,500 of them turning age 80 every day, which is more of a red flag for you to be thinking about. That should scare you. 6,000, as Ben's slide in Washington, should scare you that 6,500 boomers are turning age 80 very soon, every day, and likely going to be in those prime years for long-term care needs, and therefore those prime years of falling into the Medicare pool instead of staying upstream where they can provide private insurance solutions. So what's really, really important here is the need for public-private collaborative care and collaborative financing solutions with an emphasis on collaborative. And I'm going to spend some time talking about what I think that means. Not segmentation. You take these, we'll take these. Collaboration. Because you're not going to meet the needs of the middle-income population without a collaborative environment. And neither the Medicaid nor the private insurance market has enough dollars to cover all the care needs going forward. So it has to be a collaborative environment where both entities, both public and both private, are lifted up by each other. And so that's the depth I'm going to get into now. Lastly, I want to emphasize one more thing, the emerging trends. The cost of care, as you heard right here, $14,000 a month for assisted living, $10,000 a month for assisted living, $36,500 would not go anywhere in the city of Los Angeles. So state variation is widespread in long-term care, not only with costs, but with incidence, as well as with other differences out there. So individual states need to look at what works for them, the infrastructure they have for assisting their consumers, their residents. Some states are fantastic when it comes to home health in the Medicaid space. Minnesota's always been number 1 in that space. Washington, number 2. I think Massachusetts number 3, according to a SCAN or an AARP study.
We've been number 1 a lot too, though.
Oh, you have? Okay. But I'm Massachusetts, so we're catching up. I just work for Minnesota sometimes. So let's go to what is public-private collaboration. And for you as legislators and for your friends in the Commerce and Human Resources Department or the Division of Insurance, whatever you may call them, that's the essential question when you start thinking about how to build these programs. That's the questions they also think about when they build federal-type programs like the WISH Act. What truly is public-private collaboration? It's a key question. It can't be built in a vacuum. A long-term care public program cannot be built in a silo, in a vacuum, without the interaction, collaboration with all the departments I just mentioned, as well as the private insurance industry, as well as the advisor group like Steve over there. The roles for helping build that public-private collaboration run across the State House. So get outside your office and walk over to the Department of Insurance. Get outside your office and walk over to the Department of Human Services and have these conversations on what are we doing about encouraging people to take this burden on themselves to find private insurance. What are you doing to help build a private insurance market as a commissioner of insurance? Have those conversations. I mentioned that each state is unique, and it cannot be based, and this is the actuary saying it cannot be based on a single actuarial study. It needs to be more robust. It needs to be full stakeholder engagement like we did in Minnesota. The work we did in Minnesota, and I'll share a link with you as well, and I talked about it a couple years ago if you were here, but it wasn't an actuarial study. There was a part of it that was actuarial, but it was a completely engaged stakeholder study with companies like Alterum helping us in that endeavor. That's the kind of work you have to do to figure out how to build these public-private collaborations. And so when I think of a state exploring this opportunity, whether it's now Massachusetts or other states like Minnesota, California, and Washington, you need to clearly establish what constitutes meaningful public-private collaboration, where both the public program and the private program can both be lifted up together, where one can work well with the other and vice versa. And remember, the ultimate goal here is to create a shared safety net for the public, especially the middle-income population. Where the risk of long-term care needs and the financial burden is collectively addressed, not separately addressed. And that's what's important here. They must support one another. When they work together, they can reduce the cost of care for all the parties involved, whether it be older adults, their families, the state programs, including Medicaid, private insurance carriers, and employers alike. The approach must incentivize private insurance opportunities for reducing the risk that older adults depend on Medicaid. Unfortunately, some have implemented the one-time only opt-out of a new public program for those that currently have long-term care insurance. That's not long-term collaboration. California study, they talked about a long-term kind of not opt-out, but at least a credit for buying long-term care insurance at some point in your life. That's something that needs to be explored to have true collaboration. One-time opt-out was great for sales for the state of Washington, but it's not great going forward. It simply is not great going forward. The collaboration should not simply segment the population, as I mentioned, but collaboratively address the entirety of the population. It's not just the affluent you're trying to give credit for, but you have to have product for the middle-income population, like the policy I have for $300 a year. Probably can't write that now, but remember, I was 39 when I bought it, so age helped. So you have to have ways to encourage middle-income solutions as well, and that's where talking to your Department of Insurance is very, very important. It should be a flexible system for meeting those constituent needs over time. Informal care, home care, affordable facility care, it's about financing and care navigation simultaneously. And like I said, this is about middle-income families, keeping them out of the Medicaid pool, upstream into the public-private collaborative pool. Finally, I've written about this many times, but care models need to integrate the acute care and the long-term care. How many times have you heard stories of people being wheeled out of the hospital? Here's your chair, where's your ride? And when they get home, there's very little support, very little help, and guess what? They end up back in the hospital again. Integrated care works. It works in the Medicaid space. We heard this morning at breakfast conversation on managed LTSS. I don't think she used those exact terms, but managed LTSS works in half the states, privatizing the risk of Medicaid LTSS and dual eligibles, essentially. That model is perfect for the middle-income population as well. We just don't want to have them on Medicaid. We can keep them off Medicaid, but that kind of care coordination is essential to keep both public and private programs elevated and working well. So look into those integrated care models as best you can there. I'm going to get a little soapboxy here because I also talk at NEIC meetings from time to time, and I understand this isn't being recorded, but it doesn't matter. I'll say it anyway. This is page 1 of every NEIC model law, and this is particularly the one on Model 640 for long-term care. It was last updated in the first quarter of 2017. Before then, it wasn't updated since we were listening to music on CDs, the year 2000. And first page, this is the intent of the model reg. This is the intent of the laws that you implement as legislators when your state's insurance commissions or consumer departments bring them to fore. And the key words I see here are to promote the availability of long-term care insurance policies. These model regs are the rules that we follow to develop product. I've done so for 33 years. And they need to promote a viable long-term care insurance industry. And the question I have is, has it? Has this current product design that is now 25 years old? And we've done a lot. A lot of carriers have done some amazing work on kind of, twisting and turning and fitting this into a hybrid product model. Remember, a hybrid product is both fully a long-term care policy and fully a life insurance policy, meaning all the rules of both. So we've done a lot of good twisting and turning to make this work and to produce an innovative industry. It's time to look at these rules and regs and modernize them to today's version of listening to music, not the old CDs that are buried in my basement somewhere, and I'll probably never take them out again. We got plenty of time for questions, yes. So this model reg needs to be changed. So talk to your insurance commissioners, talk to your departments of consumer and say, hey, what is it that needs to change so that these carriers can now re-enter the market? These carriers can now speak to, we're not talking about the existing carriers, we're not talking about the carriers that left, we're talking about new carriers that are willing to come into the market and develop these types of products. One clear example of the regulatory system's inflexibility in these products is the ability to use those policy benefits to support needs before someone becomes disabled. A Medicare supplement plan, a Medicare Advantage plan can put bars in the shower, can put anti-floor slippage things, can put all sorts of things in the home to keep the person from falling, to keep the person from being at risk. What they can't do is get that funded by their long-term care insurance policy in a very profitable way or reasonable way. That's something that needs to change tomorrow, if not yesterday. And I beg and plead with insurance regulators at NIC meetings that this is something they need to do now. And next month in Minnesota, they're going to talk about this as well. So maybe it's coming, but I encourage you to talk to your colleagues in the State House on that. NAFA does have an approach to long-term care insurance. It's so important to have public-private sectors working together as these programs are being developed, but also afterwards as well. Supporting initiatives to sustain that growth in the private LTCI market, future product viability, future product innovation is there. Acknowledging that there are alternatives to standalone long-term care. There's short-term care. There's hybrid LTC with life, hybrid LTC with annuities. There's impaired annuity risk out there that's an opportunity as well. Of course, agents, and I wouldn't say that just because I'm a one-month-old advisor, but agents play a critical role in meeting those consumer needs as well, having those conversations and getting people to take action to plan for their care needs. And we also support quite a bit of other similar initiatives that are out there on the federal level as well. Now here's my call to you, what you could do. Many states have states plan on aging. Review them, know them, memorize them, talk to your colleagues about them. Discuss the existing regulatory environment with your stakeholders in your state, the commerce insurance departments, the insurance carriers in your state, the advisors. Go ahead and meet Steve Kane in California. If you're from Massachusetts, give me a call. I won't know as much as Steve, but at least I'll be able to help. I'll probably just send you to Steve. And study the projections of your state's Medicaid expenditures. Ben just shared one on Washington State. That population is growing extremely. In Minnesota, they expect by 2035, Medicaid LTSS to go up 70%. That's unaffordable in Minnesota. I think the recent projections have been up to 80%. So this is what you can do. Have those conversations. And I'm not saying go out there and copy what they did in Washington, but you got to figure out what it is your state is, what's unique about your state. There's some states that aren't as good as in home health care as Washington and Minnesota and Massachusetts. That's a blank canvas to do a lot of good work. So take a look at that. 9:58. 30 minutes for questions, right?
Okay, this has been very good, and I have to mention that I did ask when we were in Rhode Island for CIP, I asked Wilma Lofcheck, could I moderate this session? I'm glad that he gave me this opportunity because I learned quite a bit. I do have a relative that has experienced long-term care, and there was two factors that were really, really important that we should bring up. We've talked about the financial impact on families when we have loved ones requiring the care, but we also must talk about the care itself, making sure they have wheelchair ramps, making sure that they can walk to the restroom, making sure that they can feed themselves. And what I got out of this discussion so far, and I hope when we open it up to the legislators, that they are robust about this because everybody in this room is going to age, okay? And what I did is I asked my person who works for the Department of Insurance and Financial Services, does the state of Michigan offer long-term care? And of course, he came right back and said, yes, okay, so Sully, I need it, okay? But now I'm going to open up to all legislators. If you have a question, please let us know, and we're going to start off with Representative Lehman.
All right, thank you very much. Thank you. That was an intriguing discussion on a very important topic. I want to ask the panel, you might say, on a growing trend we're seeing in our area, and I'm from Indiana, very heavily agricultural based. What we're beginning to see is as I'll call it, self-impoverishment, where the old path was like my grandparents. They owned a big farm, sold their farm, used that money to go live in a nursing home till they died. Now you're seeing that same farm worth $2, $3, $4, $5 million being put into a trust. It impoverishes mom and dad, so they're basically entering now the nursing home impoverished. I know Medicaid has a look back, but if you do that when you're in your 60s and you don't use your 50s even, you don't use this till you're in your 70s, that look back period is gone. I'm also on the board of a nursing home, and we're seeing it impact our Medicaid significantly. How do you address that when you have and I'm not going to throw lawyers under the bus, but you have law firms that are advertising how to bypass and get to that Medicaid quickly without really harming your family, because they're promoting it as you're helping your family inherit this asset without it going to the government. But in reality, you're now getting care that you would have paid for out of your own pocket, but now you can't, and you don't buy long-term care because they're being told, that's your policy, is that trust. That becomes your access to Medicaid, and you can bypass long-term care altogether. How do you address that?
It's a really good question. I'm glad you brought that up. I don't like it. Like when I see these full-page ads in the paper that talk about artificially divesting yourself of assets to qualify for Medi-Cal in California where I live, I don't like it. It is legal. You can do it. You can, use a Medi-Cal friendly annuity that will do that. But ultimately, it comes down to the care. In those situations, you're talking about affluent families that are doing this. They've grown accustomed to a certain lifestyle. And I'd love to sit here and say there is absolutely no difference between my mom's private assisted living facility and a Medi-Cal skilled nursing home, but there is. And so that's the way I address it on a one-on-one basis, is talk about the lifestyle that they've grown accustomed to, maintaining that, and not artificially divesting themselves to skirt around the system. It's just not right.
So maybe a follow-up then is, because I appreciate that, but again, where I'm located, we have one facility. And so everybody gets access kind of to that facility. And part of our mission has been for 50 years, has been we're not going to turn anybody away because they can't pay. We have a foundation and we have stuff like that. So yes, they get used to a quality of life that we continue. Would it be best if those models look at taking in someone who maybe is self-impoverished? They don't get all the benefits that maybe someone else gets. To your point, if you actually have that separation now, it sounds like in California, maybe other places need to look at facilities that almost hate to say it, cater to. You're going to get you'll get the linoleum floor, the cot, and a cracked mirror, where everybody else gets the luxury.
Right.
So I think it's almost like the approach is impoverish yourself and you'll still get the same high quality of care, and bypass the whole thing.
If I could add just one quick comment to that, I think that's part of, and I've studied systems internationally a lot too, and countries, about 10 countries have universal coverage, and the efficiency of that is you don't deal with all this crap, right? All these inefficient waste of resources and the free rider problem that you're talking about, where people don't pay, they get subsidized by everyone else in society, right? A more efficient way to do this, from my perspective, is to create a dedicated revenue stream like WACARES has, where everyone pays into a fund. So we're sharing the burden equally across all the workers in the workforce. Proactively, you start paying in your 20s and 30s, and then there's money available when you get older. Rather than waiting till everyone's old, it's a crisis for the state budget, it's a crisis for families, and then there's all these disincentives to do things that don't increase the welfare of everyone, but just make money for some people at the cost of other people and create free rider problems.
And maybe just one last comment on that, and then I'll stop talking. What you just explained is Social Security.
Yeah.
And Social Security is failing. It's broke. So how do you add to something that's already failing?
Well, Social Security has problems for a few reasons. One, it's very hard to reform right at the federal level, so they weren't able to be proactive. They were in '83, but there was one big set of reforms, but that's a problem. We've done actuarial analysis for our program, and we're solving over the next 75 years. So you can hire actuaries, you can be responsible about it. Social Security got hurt by it when the pill came around and birth rates declined dramatically. That really hurt the workforce growth, and then income inequality hurt them as well. So there's a lot. But anyway, you're right. Social Security has a lot of problems, but you can avoid those by having good actuarial work, like all these states are doing.
So I'll add to that. What you're talking about is what some states have tried to tackle with clawback provisions and looking back 5, 10 years to see what people have done with their assets, like divesting themselves of their farm, putting into a trust, and charging that family, or not letting them qualify for Medicaid until those assets have been kind of recognized through that process. That works in some states, probably not very well. And other states have completely ignored it. I mean, California got rid of their asset and income test for a time. I'm not sure how well it's working, to qualify for Medicaid, right in the face of the group that was actually studying this issue, which was kind of odd. But I think what you do is, remember, Medicaid is both federal and state, 50-50 thereabouts. And I think the risk you're looking at is something that needs to be addressed at the federal level more so than at the state level. And that it needs to be something that there's a federal program that says, look, and I'm not saying WISH is the program yet, maybe it is, maybe it isn't, But there's a federal program that incentivizes people not to do the exact same thing, where everyone's participating through whatever financing means we can come up with. It doesn't necessarily have to be payroll tax, but it allows that person to say, look, I have an opportunity to get care in the home. Maybe it's the home next to the barn, next to the silo on the farm, rather than trying to sell everything and go jump into a nursing home. Because most people don't want to be in the nursing home, even the single nursing home where, people come back and meet their kindergarten classmates and so forth, like my grandma did. But you have to have something that discourages that abuse of Medicaid. And I don't think it's a state-specific answer. I think it's a federal answer. And I'm hoping that something like a public-private collaboration at the federal level does discourage that activity in the long run.
Okay. Representative Meskers.
I think it's been a very robust conversation. I've been involved as a purchaser of long-term care, and having an older parent who's now deceased who exercised a policy. One of the things I think the poorest marketing position in long-term care is that you've got a pooling of risk, and it's the cheapest way to get an annuitized form of income, because you're betting as the purchaser that you're going to make it through 3 to 5 years of long-term care, and a lot of people are going to leave their money on the table, as the good Lord calls them. So understanding that you're buying the cheapest form of annuity insurance is probably one of the biggest marketing efforts you should look at. The second piece, I don't know if this is related to Connecticut law where I reside. I didn't see any options about the triggering mechanism, because in the cases I looked at, the triggering was a 3-month certification process, and payments started in the 3-month time frame. If you think about long-term care as trying to provide income or protecting assets over time, it's as likely to look at assets that you might qualify for, but the triggering takes 6 months or 12 months. Now you have people who are calling for long-term care who may have a life expectancy of 3 years, 2 years, 5 years after the policy is triggered. Now they're drawing less of it, and so the premium might be a lot lower. I never saw any flexibility on the drawdown dates or the start date. So you qualify, you could wait 3 to 6 months to 8 months to a year. So you're using your own assets for the first year, and now you're looking at it as a substitute asset flow. And none of that was ever done or marketed either to me or on any of the publications I've looked at. So I think there's a lot that needs to be looked at there. And I think the comments about what we're finding, because I oversee some of that in my state, what we're finding is that there is a lack, there is less interest in nursing home facilities. There's assisted living or transitional living, but many people want to age in place. And I find the policies, there were comments there, the policies don't seem to have a lot of flexibility. The certification, either to make the home habitable, as you'd mentioned, or that the care, to be able to pay either a higher ratio, same benefit but higher ratio, for a certified or some type of care that's provided at home. If you think about it, for many people, if there aren't medical complications, the nature of the care you need is basically housekeeping. And it's not a nurse, and it's not administration of medicine. And I don't know how you certify it and pay it out, because you want to avoid fraud or undue claims. But I found the policies very inflexible in trying to look at alternatives in drawdowns. And that might be the counterbalance to extending the triggering time. You could still end up with a fairly priced policy and allow people to use, people they know or relatives to take care of some of that home health care, so a person can fundamentally live in their home and avoid draining money from the state. And I'd like your thoughts on some of that.
Yeah, certainly. You hit a lot of high points there, especially as a purchaser yourself of both long-term care and so we do have lots of flexibility in how we can design these policies. I spent, prior to the last few years, I spent probably 25 years building these policies, and including the leading hybrid carrier in the industry. And And we have the flexibility to do a 0-day EP. We have the flexibility to do a 180-day EP. It's hard to do anything beyond a full year elimination period is what an EP is. So we paid the first year's worth of benefits. You would pay the first year's worth of claim, and then you'd be able to be eligible after. But it's still the tax qualifying triggering event is that 2 of 6 ADLs and severe cognitive impairment, which is something the tax code needs to take a look at and needs to address. And I think regulators in the insurance space could also take a look at that and say, we don't have to wait for the IRS to make a change. If Medicare Supplement or Medicare Advantage can put grab bars tax-free in somebody's home, why can't the long-term care insurance policy do the same? That should be flat out. I don't know if they want a letter from the IRS to do so or not, but you're exactly right. We do need to find ways to get into the home, whether it's a public program or a private program, and provide care when their IADLs are beginning. Because IADLs lead to ADLs if there's no intervention. One fall in the tub and forget about it. It's going to be a chronic condition. If we can prevent that, help people stay in their home, whether it's public, whether it's a private program. And if you have like a public program that starts out doing so and then can leverage that for when they go into private insurance, that's a great thing. If it's the other way around, that's a great thing as well. That's where they have to coordinate and work together so that both may succeed. You started your comments on, long-term care as being kind of an asset play or an income protector. And that's been the theme for decades, essentially. And that conversation gets lost on the middle income. The middle income say, well, I really don't have any assets. I have a home. That's my safety net. I hope to give it to my family, give it to my kids. But outside of that, I have enough to fix the roof and maybe buy a car when I'm 80 or something if I need to replace the car. So when you talk about asset or income protection, it doesn't work, which is why we need to go back to the model of 20 years ago of how we sold to middle-income populations at the employer site or even the traditional or short-term care policies. So, but on top of that, when you're a middle-income individual, every dollar you spend in retirement is important. You can't be giving $2,000 a year away in premium and expect to have a comfortable retirement. And so that's why the hybrid model works pretty well as well, because you're going to get something out of this policy at some point no matter what. In fact, when it comes to the affluent populations on the high end, the hybrid policies were often sold as live, quit, or die. So you're always going to get a benefit from these policies. You're either going to get life insurance for your heirs, you're either going to get long-term care insurance, benefits paid for yourself, or you could quit and get your premium back. A policy that you don't have to pay anything for, it's a pretty good policy, I would think. And the middle income needs that just as much, if not more, than the affluent does. So, hopefully the NAIC listens and we start hearing about new model changes, but I think the opportunity is out there. We just have to set the environment straight.
Yeah, I want to add to what you asked about home health care. We went and queried probably the largest payer of long-term care claims, partner of ours, and about 70% of their claims start and stop at home, right? That's where we all want to be. That's where we age in place. But much of the older generation of policies out there don't pay benefits for a family member, and that's where we as an industry need to continue to evolve today's policies. I'm happy to report there are a number of insurance companies that offer family care benefits, so they just cut you a check. Once you qualify for those benefits, you meet that deductible or elimination period, they just cut you a check, and it could be a family member, a friend, a neighbor to take care of you. And so I'm happy to report there are a number of policies out there. Now, you're at a little bit higher risk. I'm not an actuary like Steve, but you're at a little bit higher risk of fraud when it comes to that, so the carriers kind of price it in. Some carriers reduce the amount of benefit by 25% or more to say, here, well, I'll just give you cash, you do with what you want, but we're going to reduce the benefit a little bit to counterbalance the fraud risk. But I think that's where it's at. Like, I always tell folks that, like, managing a long-term care event takes more than money, right? Yes, you need the money to pay for the health care, but somebody's got to get their hands dirty. And, nowadays it's families. I mean, if we're talking about that middle-income American, it's a family member that you're going to point the finger to and say, come help me. And if you have an insurance contract that will pay me $3,000 to $6,000 a month, to provide maybe a replacement to my income if I left the workforce, maybe the ability to hop on a plane and go care for a loved one because we're geographically separated these days, I think that's important. So we're going to continue to innovate with carriers. We're pushing them as distribution. When we talk about, hey, here's what we want from the next gen products, we're saying, hey, for mass middle Americans, we want more family care. Hey, we want a more affordable coverage. Maybe not the most benefit-rich coverage out there, but more affordable coverage out there. For the affluent buyer, hey, we want to stretch out that elimination period where you could use your own dollars first. You're really worried about the catastrophic, then you pay for it for the first year. So we're pushing carriers to develop options that they can take to marketplace.
I'll give you one more example about the inflexibility of the policies, and you're spot on. There are 13 different benefits in a long-term care policy. Sometimes they have 15. One of them that drove me insane when I was working with a vendor and when I was working at a carrier is caregiver training. You can't provide a caregiver training benefit until someone's 2 of 6 ADLs or severe cognitive impairment. Well, the family member would have loved caregiver training 2 years ago when the ADL dependencies began, when the impairments began, and they asked for it, and we can't provide it because of IRS reasons. So yes, we build concierge care-like programs to help them through it, but there needs to be a change in the regs to allow that obviously needed benefit to be activated earlier rather than later.
Excuse me. Yes, we do have a couple legislators that would like to ask questions. Senator Woods, you're good? Okay. Okay. Is that Representative Ellen Hefner? Is she here? Yeah.
Thank you. Thank you. Apologize. Thank you for taking questions. The gentleman that showed the surveys, did you survey any southern states or heartland states?
Was that the EBRI survey? I don't know the details of which states, but it's a multinational company, like I said, that delivers boxes to your front door. So it pretty much is employees in every state.
I just saw that, like, I saw California was on there, Massachusetts, I think. I didn't see any, Texas, Oklahoma.
Sorry. Those 2 lines are separate items. One talks about where some of this work is being done, the WISH Act, Washington, California, Minnesota, Massachusetts. Then the next item was kind of results of that study. The last slide gives you a link to the exact study itself, and we'll tell you where those employees were surveyed.
So, Mike, I have a comment, this is great. Long-term care is great. I sell it. Life insurance is great. But the reality in Oklahoma is that we have the second highest uninsured rate for insurance for health. So there's not enough wages there to pay for these products. We don't have the opportunity to have some group benefits for people that are, not getting those high-paying jobs. My question is, these are great products, definitely. The hybrid's great, all that. My question is, are we looking at something else? Are companies really looking at something else that can help the majority of people who can't afford it? Because if we put that to the state and said, we want you to pay more money to do a private-public partnership in our state, that's not a reality for us. And so I'm just wanting to know what else we're doing, because the products aren't changing very much to make it affordable. And with the growing amount of Medicaid and being cuts, that less money coming into the state, it's going to have to be some more private into this formula. I don't know.
If I could start out just briefly. So I hear what you're saying, and in our state we have a social insurance solution where everyone pays into a fund. I know that that's not going to be politically feasible in many states, right? Particularly the states that you mentioned. The one thing I would highlight is the private market is fantastic, but it's not. I don't think it's ever going to solve most of the problems that you're talking about. Although I'm sure Steve and Steve will disagree, and they can contribute their perspectives. What I would encourage all states to do is a multi-sector plan for aging. The aging problem, this tsunami that's coming at us, often appears from a state legislator perspective as a Medicaid budget problem, and then the solution appears to be, well, let's cut Medicaid, or let's put constraints on Medicaid so that the costs don't grow. We're doing that in our state right now, and but that solves a budget problem. It doesn't solve the problem that families face, right? That's a problem that's still out there. So multi-sector planning encourages states to bring together their transportation, housing, long-term care agencies, as well as private sector providers, and say, come sit around the table and come up with a 10-year plan for how are we going to make it possible for everyone to age in a better way. That can be done without a payroll tax, and it's not just private insurance companies can be at the table of those discussions. They play a critical role, but the public sector has to do more. And it's going to require more money, but a lot of it isn't just money, as Steve was saying. It's just making planning resources available, having a good no wrong door navigation system that helps people figure out how to care, what the options are for caring for mom or dad. What are some lower cost options? So there's a lot that states can do other than an insurance program. So I'll pass it to you.
I'll say that we have seen a little bit of innovation in the industry over the last few years. There are some products out there called short-term care, and the max benefit payout is 1 year. Typically, they'll look at some higher health risks or some concerns, and so no, it's not going to cover a long and exhaustive long-term care benefit, but 1 year might be enough for a lot of people, and so we've seen that. Also, with the incredible growth that we've seen in worksite long-term care, the premiums are affordable to a lot of employees. So in that scenario, my client is not the CEO. My client is not somebody making $250,000 and up. My client is 40-something years old that's making $80,000 a year. Average premium that we're seeing on the worksite life plus long-term care is about $100 a month. And so it kind of, we're so happy about the evolution of those products because it kind of democratized, the conversation around long-term care. It wasn't just for a very wealthy client. Do we need to do more? The answer is yes. Can I solve the problem? If somebody is not, doesn't have health insurance, if somebody's not contributing to a 401k, they are not suitable for long-term care insurance today. Like we would say, no, you need to focus on that first.
Two very quick things I'll add to that, and I think some of the points already made have been fantastic. A lot of individuals, whether it be in the private employee market or state employees or municipal employees in your state, I'm sure buy group life insurance, and this is term insurance usually that they lose when they leave. Add in a more permanent solution like Steve has mentioned with a long-term care rider on it, and you've not really increased their costs too much to begin with, as Steve mentioned. The other thing to take a look at is a lot of states, a vast majority now, do have the privatized kind of managed LTSS programs, where that's where middle-income populations can rely upon those programs to stay in their home even if they're qualifying for Medicaid. And so I'm not saying that's the bucket you reach after first, or whether this, enabling the private market to go out there, but if your state is facility biased in their Medicaid long-term care solution, you need to look into some home-based approaches. When you look at Arizona, I've seen stats out there that says more than 95% of Medicaid eligible long-term care recipients are getting care at home. I mean, that speaks volumes as to cost savings for Medicaid. It allows them to go higher upstream to help more people with their Older Americans Act work and other things like that. So there's two fronts for a state that doesn't really have the private market yet, or that doesn't have kind of the managed Medicaid space as well. It's no accident that the states that have kind of their Medicaid long-term care act together are looking at public-private solutions because they have that infrastructure to build a pretty good public-private solution. Washington, Minnesota, Massachusetts, and somewhat California.
Okay.
Go ahead. If I could add, you can also save a lot of money by bringing all the different actors around the table and planning together. I've seen, the Netherlands does a great job with this. They have everyone at the same table planning for the next 10 years. And you'll find that there are synergies. Like Steve was saying, if you have a better home care system that saves money for the insurers, it saves money for Medicaid, it helps families. Even when there's scarce resources, you can address the problem's going to be expensive no matter what. If we do nothing, the tsunami's still going to come. It's not going to not come because we didn't act, right? But the more that we plan together, that tsunami analogy is a really good one. Every family could plan individually to get out from the water coming in, or you could come up with a collective solution where you come together. And it doesn't all have to be public sector, but the public sector can be a convener for all the different parties, the nursing providers, the hospitals, the home care agencies, the insurers. And so the planning is what I think is the most important part.
We have time for one final question, and that will come from Senator Justin Boyd.
Thank you, Madam Chair. Over here. So really, I think this probably goes to somebody from the industry, but whoever can answer it is fine with me. So in Arkansas, and I know several other states have this, we have what's called a qualified partnership long-term care. Does that just not work? And if it doesn't work, why doesn't it work? So do I need to describe what it is? Do you know what I'm talking about?
You're talking about a partnership policy where you are able to spend down your assets.
Right,
Or
so if I have a
protect your
long-
assets up to, and I think there are a lot of partnership policies out there. I think that works, but you still have a lot of the people now, and I think that it would work more for middle income people. But right now, the people that have policies, they don't necessarily even want to spend their assets down to their long-term care benefits, right? And so I think that seems like it doesn't work as well as we had intended for it to work when the partnership program was first established.
Yeah, I agree. I think we thought it was going to be incredible, a catalyst to have long-term care conversations. And frankly, it wasn't as incredible as we thought. People still weren't ready to have the long-term care planning conversations. What did help, though, around the country, because there were a number of partnership states and programs, was there was a marketing push from the states. I mean, so state governors were sending letters out to folks, I think 50 plus, and that really helped with the initial activity in terms of partnership policies sold. Today, if I'm dealing with a client in Arkansas that's not a very wealthy client, we're bringing up the fact that this policy we're talking about has added consumer protections, and you're able to do this with it. But is it driving more and more sales? No.
So since I'm a Cubs fan, I'll be the optimist here. I loved the partnership program when it first came out. I thought it was the right call. I don't think the market has been built to support the partnership program. For one, the initial requirements of the partnership program that you must buy a 5% inflation policy, and that made policies for the middle income population exorbitantly expensive. My $300 policy does not have any inflation, and I like it for that reason because it's cheap. It's not my complete solution. I obviously have to have something else in there, or more kids, but for the most part, partnership still has to be given a chance. In the last 5 to 10 years, we've seen a lot of states go back and say, look, you don't need the 5% inflation to be qualified under partnership. And so if you have a policy that only pays $200,000 and your policy is partnership eligible now without inflation, and you spent those $200,000, that means you get to keep $200,000 of assets and qualify for Medicaid. That solves the gentleman with the farm question earlier, is that if you bought that policy, not only do you get to have the protection of a long-term care policy, but you keep the farm too, and then go on Medicaid when you should, after you've expended the assets from that particular policy. So I think as we see more middle-income solutions, because right now the vast majority of policyholders in long-term care are affluent. We sold a ton of policies to the very risk-averse people in this country, and they all bought them, and now they're all using the policies, which is why we have rate increases. That's a theory, but I think it's well-founded on who actually bought these policies. If we had sold a lot more policies like the one I have that were partnership eligible, you would see a lot more success in those partnership programs. A lot more people qualifying for Medicaid after their 2 years or $200,000 of policy has been paid, and now they're enjoying the benefits of being Medicaid eligible, perhaps being on a Medicaid home health program as well. So I don't want to say we should remove partnership programs yet, but we need to give them a chance with a new reinvigorated product environment, public-private collaboration as well. In fact, Walk Cares should be partnership eligible. It isn't, but it should be considered partnership eligible so that someone who spends $36,500 from the policy they purchased over these years could also qualify for Medicaid. There's a lot more math than what I just said in there, but I think partnership should be given a chance, but we need to have the new environment of products that support the middle income to make it as effective as it could have been when first thought of.
Okay, everyone. I know I asked for a robust discussion. We got one. But now it's time for us to move on to our next committee, which is Property and Casualty. We'd like to thank the panelists for being here, and thank you, everyone, for being here. We're going to take a short break, and then we'll convene for Property and Casualty right in this room.